In this webinar, we cover Ira Contribution Rules.
IRA accounts. So in this webinar, I'm going to talk to you about traditional IRAs and Roth IRAs. Just those two types of retirement plans. And it's going to take a lot of time just to cover these two retirement plans. This is a very long webinar. But these are not the only types of retirement plans that exist. There's a whole nother subset of retirement plans that apply to businesses. That includes retirement plans like simple plans and 401k plans and SEP IRAs. Those are for businesses, and they also apply to self-employed people. A self-employed person can set up a solo 401k for their business, for their Schedule C business. They don't necessarily have to have employees in order to do it. But I'm just going to talk about traditional IRAs and Roth IRAs in this webinar. There is a small section in this chapter in the book for business retirement plans, but if you want to see the webinar for business retirement plans, it's in the webinars for part 2. And if you have no experience whatsoever with retirement plans at all, I suggest that you watch both of those webinars before you take part 1 and part 2. Okay, but in this webinar, I'm just going to talk about traditional IRAs and Roth IRAs. Now, traditional IRAs and Roth IRAs have some similarities, but they also have a lot of differences. These are treated differently under the law, and what's taxable and when you can contribute and how you can contribute, all of those rules are different. Yeah. But traditional IRAs and Roth IRAs are individual retirement accounts. That's what IRA stands for, individual retirement accounts. You don't have to have a business in order to contribute to either one of these types of accounts. You can just be earning wages from a regular job. For example, let's say you have someone who's working for a job and it's a small business and they don't offer a retirement plan to their employees. Well, you could go down to your local bank or credit union and you can open up a traditional IRA or a Roth IRA and start contributing to either one of these types of retirement accounts. As long as you have qualifying compensation, you can do it. You don't have to have a business. Now, with regards to traditional IRAs, amounts in a traditional IRA, including contributions and earnings, are generally not taxed until they are distributed. So with a traditional IRA, generally, when you put money in, you get to deduct it from your AGI. It's an adjustment to income when you contribute to a traditional IRA. And then when you take the money out later, hopefully at retirement and not early, so you don't get hit with a penalty, you wait until you retire. And then when you pull the money out, then it's taxed at that point. So it grows tax-free, and then it's not taxable until you pull the money out of a traditional IRA. With a Roth IRA, contributions to a Roth are never deductible. You never get to deduct your contributions to a Roth. So unlike a traditional IRA, a contribution to a Roth will not lower your AGI. You can still use it for tax planning. Most people who contribute to a Roth IRA do it because they know they're not going to get a tax benefit now, but they're going to get a tax benefit later. Unlike a traditional IRA, withdrawals from a Roth IRA are generally not taxed. They grow tax-free, and then when you get to retirement, you get to pull the money out, and it's not taxed when you pull it out. A traditional IRA is the reverse. So a traditional IRA, it grows tax-free, but then it's taxed when you pull it out at retirement. Roth IRA is the opposite. You don't get to deduct it when you put it in, but then it grows tax-free, and it's not taxed when you pull it out. There's income limits with a Roth. You can't contribute directly to a Roth once your AGI goes above a certain level, which is a drawback, but you can still do a backdoor Roth IRA, which means people who are higher income earners, they can contribute to a traditional IRA and then convert it to a Roth. So Roths still technically have income limits, but if you are a higher income earner and you want to still contribute to a Roth, the way that you do it is you contribute to a traditional IRA first, and then you convert that traditional IRA to a Roth. You can still do that. So Congress forces you to go through that extra step. if you have a higher AGI where you can't contribute to a Roth directly. That's called a backdoor Roth. One thing that seems to confuse newer preparers, and I'll admit that this confused me too at the beginning when I first started in this business, is when the contributions to a traditional IRA are actually deductible. Okay, because there are times where you cannot deduct your traditional IRA contribution. That only happens when a person also has a retirement plan at work. If you do not have a retirement plan at work, or if you're married, if your spouse doesn't have a retirement plan at work, you can always deduct your traditional IRA contribution. Always. It doesn't matter how much you make. You can make $1 million in wages or self-employment income. And if you have no other retirement plan, then you can always deduct your traditional IRA contribution. The times when a person cannot deduct their traditional IRA contribution, and they have to basically report it as a non-deductible contribution if they do contribute, is when they are covered in two places. Is when they have a traditional IRA and they want to contribute to their traditional IRA, but they're also covered by a retirement plan at work. Like, I'm working and I have a 401k at my workplace. I'm covered by that 401k and I'm contributing to that 401k, but I also want to have a traditional IRA and contribute to that too. Many times people, especially when they get closer to retirement age, they want to try to save as much as they can. You can still contribute to a traditional IRA if you are covered by a retirement plan at work. As long as you have qualifying compensation, there's nothing stopping you from doing that. Okay? I want you to understand that. You can still contribute to a traditional IRA if you have, for example, a 401k at work. That's where I see it the most often. Someone has a 401k at work. You know, they're working for an employer. They have a 401k at work. They're maxing it out. All right? They're getting close to retirement and they want to put as much as they can into their retirement fund. They're maxing out their 401k at work. And now they want to also save more in a traditional IRA. They can do it. They certainly can do it as long as they have qualifying compensation. They can do it. There's nothing that prohibits them from having both. But there's a point where once your income goes above a certain level, you can no longer deduct your traditional IRA contribution if you also have a workplace plan. Okay? And I'm going to show you where the thresholds are on the IRS website so you know how this works. Because like I said, this confuses a lot of preparers, especially when they're first starting in this business. Deductibility of IRA contributions. The deductibility of a traditional IRA contribution. Now we're just talking about traditional IRAs now, okay? Because you can never deduct a Roth IRA contribution. Roth IRAs are never deductible because they grow tax-free, and then when you pull the money out, it's not taxed. So you can never deduct a Roth IRA contribution. So I'm just talking about traditional IRAs right now, okay? The deductibility of a traditional IRA contribution is based on income, filing status, and whether the taxpayer or their spouse is covered by an employer retirement plan at work. Any taxpayer with qualifying compensation is permitted to contribute to a traditional IRA, regardless of whether they are covered by an employer retirement plan. However, the deductibility of the contribution may be limited. If a taxpayer makes non-deductible contributions to a traditional IRA, the taxpayer must file Form 8606 non-deductible IRAs. This is required. So if you do make a contribution to a traditional IRA and you do not deduct it, you can certainly do that, and you do not deduct it, you have to file Form 8606. This reflects the taxpayer's cumulative non-deductible contributions, which is the taxpayer's basis in the IRA. Okay. Now, sometimes you will hear this thrown around, the taxpayer's basis in the IRA. Most of the time with traditional IRAs, taxpayers don't have a basis in that IRA, which means they've deducted their contributions to that IRA. Okay, which means that when they go to pull the money out later, then those distributions are going to be taxable. But sometimes people will make non-deductible contributions to their traditional IRA. If they do that, they are required to keep track of how much they've put into that IRA that's non-deductible contributions. If they do not, then the IRS will basically assume that all of the money in there was deducted and that they do not have a basis in that IRA. So if a taxpayer does not report non-deductible contributions properly, all future withdrawals from the IRA may be taxable unless the taxpayer can prove with satisfactory evidence that non-deductible contributions were made. And the way that you do that is by filing Form 8606. And then sometimes people will ask me, how long do I have to keep tax records? How long do I have to keep tax records? When it comes to this, the Form 8606, you need to keep these forever. Let's say I make a non-deductible contribution to my IRA when I'm 40 or 50, and then I get to be 70, and I want to pull money out tax-free. Well, I better have copies of these. I better have proof that I did this, because it's up to me to prove to the IRS that I actually have basis in that IRA. Otherwise, the IRS will just consider all of the withdrawals to be taxable. Okay, because most of the time they are. Most of the time people don't have a basis in their IRA. Most of the time people do deduct their IRA contributions. But if you don't, you need to file this form, and then you need to basically be able to prove that you didn't deduct your IRA contributions. It's on you. Okay? All right. If neither the taxpayer or their spouse is not covered by an employer plan, there is no limitation on the deductibility of either of their traditional IRA contributions as long as the taxpayer has qualifying compensation. And I'm going to show you where these limits are on the IRS website because I really want you to understand this. I know that this is super confusing, but I really want you to understand this. The limits are in your book too, but I feel like seeing it on the IRS website really brings it home. Here I am on the IRS website where it talks about IRA deduction limits. And I'm going to go over this with you because I really want you to understand this concept. At the very top of the page, it says Roth IRA contributions aren't deductible. So we're not talking about Roth IRAs here. We're only talking about traditional IRAs. Now, retirement plan at work. Your deduction may be limited if you or your spouse, if married, are covered by a retirement plan at work and your income exceeds certain levels. If you do not have a retirement plan at work, or your spouse does not have a retirement plan at work, if married, your deduction is allowed in full. Okay? We're only talking about limitations when a person has a retirement plan at work or their spouse does. Now, it gets confusing when it's a spouse that's covered by a retirement plan, but I'm going to explain it. I'm going to explain it on both, okay?
Now, I clicked on the link for 2023. That's the year that you are going to be tested on in this testing cycle. As you can see at the top of the page, it says 2023 IRA deduction limits, effect on modified AGI on deduction if you are covered by a retirement plan at work. This only applies when a taxpayer is covered by a retirement plan at work. If you are not covered by a workplace retirement plan, you don't need to worry about any of this, and you can deduct your IRA contribution in full. Okay? Assuming that you're not married and you don't have a spouse that's also covered by a retirement plan at work. But if you're a single person or if you're filing head of household and you don't have a retirement plan at work, then you can deduct your traditional IRA contribution in full. As you can see right here, it states that if your filing status is single or head of household and your modified AGI is $73,000 or less, you are allowed a full deduction up to the amount of your contribution limit. And contribution limit means the amount that you're allowed to contribute based on your age. And I'm going to go over that in a minute. I'm going to go over that next. That's one of the slides that we have after this. The full deduction up to the amount of your contribution limit, assuming that you have enough qualifying compensation in order to contribute. But if you are single, for example, let's say you have a single person and they have $73,000 or less in income from their job, let's say. Let's say they're not self-employed and the only thing they've got is wages. And let's say they made less than $73,000. Even if they're covered by a retirement plan at work. Like, let's say I have a 401k at work and I'm maxing it out. I'm putting as much as I can into that 401k every single year. But I also want to save a lot more for my retirement because I'm getting real close to retirement age. I can go down to my local bank or my credit union and set up a traditional IRA and also contribute to my traditional IRA. And if my AGI is $73,000 or less, then I can also deduct the amount of money that I put into my traditional IRA as well, my full contribution. But once I make more than $83,000, as you can see on this table, then I get no deduction. And I have to file the form 8606 along with my tax return to report that I made a non-deductible contribution to my IRA. And this is assuming that I'm single or head of household. There's a higher AGI limit for married filing jointly or qualifying widower. The taxpayers who are married filing separately here at the bottom of this table are at the biggest disadvantage. If they are married filing separately and they live with their spouse at any time during the year, then their threshold is really low. Basically, they can't make a traditional IRA contribution and deduct it if they made more than $10,000 during the year. So it's a really low threshold. Although if you file separately, as you can see down here at the bottom of the table, if you file separately and did not live with your spouse at any time during the year, your IRA deduction is determined under the single filing status. So if you have taxpayers who are like physically separated and they're still filing MFS because, they haven't filed for divorce yet or they're not legally separated or whatever, but they've lived apart all year, then they can use the single filing status thresholds if they're married filing separately. But if you live with your spouse at any time during the year, then your phase out starts at $10,000. So most of the time, people who are married filing separately are not going to be able to take a deduction for their traditional IRA if they are already covered by a retirement plan at work. All right. Now, the second aspect of this deductibility with regards to being covered by a retirement plan at work has to do with whether or not your spouse is covered by a retirement plan at work. If you're not married, then this is a moot point and you don't need to worry about it. But if you are married, if you do happen to be married, and you are not covered by a retirement plan at work, but your spouse is, then the fact that they're covered by a retirement plan at work can eliminate the deductibility of your IRA. And I don't understand why Congress did it this way. I feel like this is a really unfair rule. Like, why should it matter what my husband is doing at his work? Why should that affect the deductibility of my IRA? But this is how it is. Okay, once again, if you are not married, then you don't need to worry about this. This only applies to married people. As you can see, it's the effect of modified AGI on the deduction if you are not covered by a retirement plan at work. And this is a separate table. This is not the same table that I was just looking at with you. This is a separate table. This is the one that covers what happens when you have a spouse that's covered by a retirement plan at work. If you are single, head of household, or qualifying widower, then you don't have to worry about it and you can make a full deduction up to the amount of your contribution limit. If you are married, filing jointly or separately with a spouse who is not covered by a retirement plan at work, once again, you can make your traditional IRA contribution and fully deduct it. And what this means is if neither of you are covered by a retirement plan at work, so my husband and I, let's say, and we each have a job and neither one of us has a workplace retirement plan. And if we do, it's on the W-2. There's a checkbox there that you have to check when you're putting this information into your software that shows whether or not you're covered by a workplace retirement plan. And it doesn't matter whether you contribute to that plan or not. Just the fact that you're covered by that plan, it can potentially affect the deductibility of your IRA contribution. But in this case, we're talking about spousal retirement plans. So if you're single, head of household, or qualifying widower, that means you're not married. So you can take a full deduction up to the amount of your contribution limit. If you're married filing jointly or separately with a spouse who is not covered by a retirement plan at work, no problem. You can make a full deduction up to the amount of your contribution limit. However, if you are married filing jointly and the two of you together if your modified HEI is $218,000 or less, then you can make a full deduction up to the amount of your contribution limit. So let me explain this scenario again. Let's say it's me and my husband, and he's covered by a 401k at work, and he's putting money into that 401k. That's perfectly fine. And then I have a self-employment gig. I'm working my tax preparation business, and I have a Schedule C business, and I'm making money doing that too. If we make together, if our modified AGI together is $218,000 or less, then I can deduct the full amount of my traditional IRA contribution, even if he's covered by a workplace retirement plan. However, once we start making more than this, remember this is a joint filing, right? This is a joint tax return. So our modified AGI, if it's more than 218,000 but less than 228, then it gets phased out gradually and I get a partial deduction. You wouldn't have to do any of these types of calculations. I just think you really need to know the rules about this, especially the rules that apply when you're MFS. Okay, it's very possible that they're going to ask you about that. Because MFS filers, once they live with their spouse, then their AGI limit is like $10,000, where they don't get the chance to deduct their traditional IRA contribution. So remember that rule. Then, if you're married filing jointly with a spouse who is covered by a retirement plan at work, and you make $228,000 or more, your modified AGI on your joint tax return, then you get no deduction. So once again, let's say it's my husband and I, and he has a retirement plan at work. He's got a 401k. Let's say that's probably the most common one you're going to see, especially if you're working for a big employer. He has a 401k at his job, but I don't have any kind of retirement plan because I'm self-employed. And together on our joint tax return, our joint AGI is more than $228,000, then I don't get to deduct my traditional IRA contribution. And I have to file the Form 8606 in order to report that I made a non-deductible contribution to an IRA. Now, once again, if you're married filing separately and you have a spouse that is covered by a retirement plan at work, it's less than $10,000 is your threshold. So probably you're not going to be able to deduct your traditional IRA contribution. But if you are married filing separately and you do not live with your spouse at any time during the year, then you're allowed to use the single filing status, which is just up here, and you'd be able to fully deduct it. If you didn't live with your spouse even one day the whole year, then you would just be treated as single under this rule for this purpose. IRA contribution limits. The limits for contributions to an IRA in 2023 are the lesser of qualified taxable compensation or the following amounts. It's $6,500 per taxpayer, and if you're 50 or older, you get a $1,000 catch-up contribution, which means that if you are 50 or older, you can put in $7,500 into either a traditional or a Roth. Each spouse must have their own IRA account, but in the case of married spouses that fall jointly, only one spouse must have qualified compensation. This is called a spousal IRA contribution. If, for example, you have a married couple and only one of them is working, if they file a joint tax return, then the working spouse can actually contribute to the non-working spouse's IRA. But IRAs cannot be owned jointly. They have to be owned by separate individuals. Each person has their own IRA. But if you're married and only one spouse is working, if they file jointly, then the working spouse can actually contribute to an IRA for the non-working spouse. And I think you need to remember these limits. It's very common on the EA exam for them to give you an example where one spouse is under the age of 50 and the other spouse is older than 50 years of age. And then they'll ask you, what's the maximum that these spouses can contribute? So you'll have to know that one of them is actually able to contribute $7,500 and the other one contributes $6,500. So I do recommend that you write down these ages. It's $6,500 in 2023 unless the taxpayer is 50 or older, and then they get to put in $1,000 more, which is $7,500. And be on the lookout for tricky questions on the EA exam when you have two spouses and one of them is over the age of 50 or 50 or older and one of them is younger than that. That's a trick question. They've absolutely thrown that at EA exam candidates in the past. This yearly IRA contribution limit does not apply to rollover contributions. For example, if you're rolling over your existing IRA into another IRA account because you don't like the bank that you're with or whatever, then there's no limit like this 6,500 or 7,500 if it's a rollover, if it's a qualified rollover. If it's a qualified reservist repayment, or if it's a repayment of a qualified disaster distribution or a coronavirus related distribution and you're repaying that distribution, the last year for repayments is 2023. There's not going to be any more coronavirus related distribution repayments after 2023. This was the last year. The next webinar covers IRA disaster distributions and repayments. In this video, we cover IRA disaster distributions and repayments.
Disaster distributions. Taxpayers who took out a qualified disaster distribution, that's called a QDD in the pubs, they shorten it to QDD, or a coronavirus-related distribution, this is a CRD in the IRS publications, that's how they shorten that one, from their IRA may repay the distribution. And to be honest, a lot of taxpayers are doing this. They took money out, usually a coronavirus distribution is what I'm seeing the most. They took money out because they were allowed to as a coronavirus-related distribution. They were able to take the money out without a penalty, but it was still fully taxable. So a lot of taxpayers were kind of surprised by this. They heard on the news that they were allowed to take money out of their traditional IRAs for coronavirus, right? And then they took the money out and then they regret it afterwards. They want to pay it back. If they took money out and it was a qualified disaster distribution or a coronavirus related distribution, they're allowed to make a partial or a full repayment, and they can put the money back into their retirement accounts. And they have 3 years from the date of the distribution in order to do this. Do not confuse a qualified disaster distribution or a coronavirus related distribution with any other type of emergency retirement distribution. These were distributions that Congress allowed specifically for coronavirus and qualified disasters. Okay, these were generally allowable distributions of up to $100,000 from certain retirement plans for specific disasters. These were for past disasters and also for coronavirus related distributions that occurred in the past. They are allowed to repay them now if they want to. They have up to 3 years to repay these amounts. So unlike most distributions, taxpayers can choose to recognize the income ratably over 3 years, and taxpayers can also choose to repay a qualified disaster distribution or a qualified coronavirus-related distribution over a 3-year period. The repayments are treated as a trustee-to-trustee transfer. So if a person pulled money out of their retirement account because of coronavirus, and they pulled up to $100,000 out of their account, and then they regret it, and they want to repay it back, they can, if they want. Last point on this slide. The Secure Act 2.0 includes a retroactive provision, which includes permanent relief for those impacted by federal disasters. This provision in the Secure Act 2.0 is not related to these other types of qualified distributions, these qualified disaster distributions or coronavirus related distributions. This is unrelated to these other types of distributions. The Secure Act 2.0 includes a retroactive provision for qualified disasters. This provision allows penalty-free disaster distributions of up to $22,000 from a retirement plan per participant, per disaster. And it's just this random amount. It's $22,000 per participant, per disaster. So if, for example, you are living in a state and you get hit by a hurricane at the beginning of the year, and then you get hit by another hurricane in the second part of the year, like you get hit by 2 disasters, your house is destroyed once, and then your house is destroyed twice, then those are 2 separate disasters. Potentially, you could have penalty-free disaster distributions of up to $22,000 per disaster per participant. Now, if a taxpayer does make a distribution like that, either because they had a coronavirus distribution in the past, or if they had a disaster distribution in the past and they want to repay it, like they want to put the money back into the retirement account because they regret taking it out, or maybe they have the funds now and they want to repay these amounts, then there's a specific form that you use to do that. It's Form 8915F. As you can see, it states qualified disaster retirement plan distributions and repayments. In this case, as you can see, 2023 is here, and that's potentially the last year that you're going to be able to have a coronavirus distribution repayment. If somebody took money out during the coronavirus pandemic and then now they want to put it back. But there can be other types of distributions, like disaster distributions, that the taxpayer can repay at a later date. The IRS usually will release guidance in dribs and drabs when it's this sort of thing. They won't release guidance right away. And I don't necessarily think that you have to even memorize this form number. I just want you to understand that for the test, when it comes to this type of a repayment, you're putting money back in to the IRA. And if you do that, then the money that you put back in, if it's this type of a repayment, is not going to be subject to those annual limits. That's the thing that you have to remember for the test. For example, if I took out $45,000 and it was a disaster distribution because my house was destroyed or whatever, and I really needed the money, and then later I changed my mind and I want to put that $45,000 back in, then I'm allowed to recontribute that entire $45,000 if I want, as long as I indicate that when I am doing that to the IRA trustee, that it's a disaster distribution repayment. Like, I took this money out because of a disaster and now I want to pay it back. As long as it's classified correctly, both on the tax return and when you actually do make the recontribution to your retirement plan, then it's not going to be subject to those limits, the annual limits, because obviously if you recontribute $45,000, that's a lot more than the annual limit. But it's not subject to the annual limits if it's a repayment of a disaster distribution, or in the case of a coronavirus distribution. But 2023 is going to be the last year that you're going to see that. And as you can see right here on this letter C of the form, you have to put in the disaster number if you're actually repaying your disaster distribution, or if you are taking a qualified disaster distribution, then you put the FEMA disaster there in order to avoid a penalty. And then in the future, if you want to repay those amounts, you're allowed to do that and you're not subject to the regular annual limits. Okay? Next webinar is going to cover the qualifying compensation for IRA purposes. In this webinar, we cover qualifying compensation. Let's talk about qualifying compensation now. In order to make contributions to an IRA, the taxpayer must have qualifying taxable compensation, such as wages, salaries, commissions, tips, bonuses, or self-employment income. They have to have qualifying compensation in order to contribute to an IRA in the first place. For the purposes of making an IRA contribution, taxable alimony, but not child support, counts as qualifying compensation. So if you have a taxpayer who is receiving taxable alimony because their divorce decree is grandfathered, then that taxable alimony is still allowable for IRA contribution purposes. And this was always the case in the past. It's just that the Tax Cuts and Jobs Act made changes to alimony for divorce decrees starting in 2019 and onward into future years. But if you do happen to have a taxpayer who has a grandfathered divorce decree and they're still recognizing their alimony as taxable alimony, then they're allowed to use that for making an IRA contribution specifically. And this was always the rule in the past. It's just that now, in future years, if you have someone who gets divorced and they have alimony coming in, it's not going to be taxable to them. So they can't use those amounts as qualifying compensation for an IRA. But on a grandfathered divorce decree, they can. Non-taxable combat pay also qualifies as compensation for this purpose. So if you have a person who is a service member and they're in a combat zone and they're receiving non-taxable combat pay, they can choose to treat that income as taxable for contributing to an IRA if they wish. They don't have to, but they can if they want to. Difficulty of care payments, also called qualified Medicare waiver payments, are also considered qualifying compensation for IRA contribution purposes. And this is true even if the amounts are not subject to income tax. However, the amounts contributed are non-deductible and create basis in the IRA in that case. If a taxpayer has Medicare waiver payments and they're non-taxable, those are just treated as non-deductible contributions to an IRA. But they can use those amounts in order to contribute to an IRA if they want. In prior years, there were age limits to contribute to a traditional IRA. Once taxpayers reached a certain age, they were no longer allowed to contribute to a traditional IRA. But the age limits were abolished by the Secure Act 1.0. So in 2019, those age limits were abolished. And anyone with qualifying compensation, regardless of age, may contribute to an IRA if they want to, but they still have to have qualifying compensation. So this means they still have to be working. Not compensation for an IRA. So you need to know what is not qualifying compensation for an IRA. You need to know this for the test. Compensation for purposes of contributing to an IRA does not include child support or non-taxable alimony. It has to be taxable alimony if they want to contribute to an IRA. Passive rental income. This would be rental income that was reported on the Schedule E. Now, if you have rental income and it's like an Airbnb or a hotel or a motel, and that income is reported on the Schedule C and it's subject to self-employment tax, then that is qualifying compensation for an IRA. But if it's passive and it's not subject to self-employment tax and you're reporting it on the Schedule E, then that is not qualifying compensation for an IRA. And that's a very common trick question on the exam. They'll give you a situation where the taxpayer has like a mix of different income. Maybe they have a little bit of wages, but then they have passive rental income, and then they have dividends and interest. Those passive income sources or that portfolio income like dividends and interest, that's not qualifying compensation for an IRA. So you need to know that for the test. If they're receiving pension or annuity income, dividend and interest income, deferred compensation, prize winnings or gambling income, and then any other items that are excluded from income, such as certain foreign earned income and excludable foreign housing costs, that's not compensation for an IRA either. So for example, if you have someone who's living and working overseas and they have $50,000 in wages or $50,000 in self-employment income, that's qualifying compensation for an IRA as long as they don't choose to exclude it all. If they choose to exclude all of their income using the foreign earned income exclusion and it's not taxed, then that's not compensation for an IRA either. Okay, if it's not taxable, then it's not going to be compensation for an IRA. The only exceptions to that rule are if the taxpayer has non-taxable combat pay, then they can treat it as taxable in order to contribute to an IRA, or qualified Medicare waiver payments. Then they can still contribute to a traditional or a Roth in that case. Okay? Examples. Barry is 53 and wants to contribute to an IRA. He received $15,000 of capital gains from the sale of stock, $12,000 of interest income, and $3,200 of wages from a part-time job. The rental and the interest income are not considered for the purposes of determining his IRA contribution. Therefore, the maximum he can contribute to an IRA is $3,200, the amount of his wages. So this would be a common type of trick question that they might give you on the exam. He's 53, right? So normally, he would be able to have the higher contribution limit. He would be able to make a catch-up contribution, but only if he had qualifying compensation. The only qualifying compensation he has is the amount of his wages. So the most that he would be able to contribute for the year is $3,200, which is the amount of his wages. That's regardless of whether or not he makes a contribution to a traditional or a Roth IRA. Either one. For either one, he has to have qualifying compensation. And the only qualifying compensation he has is the amount of his wages. So his IRA contribution would be limited to $3,200. Example number 2. Leroy is single and 65 years old. He received $14,000 of rental income from a residential rental and $23,000 in pension income during the year. All of his rental income is passive, so it's a Schedule E rental. It's not subject to self-employment tax, which is great, right? Most people don't want to pay self-employment tax. But in this case, he wants to contribute to a traditional or a Roth IRA, and he can't, because the passive rental income and the pension income are not qualifying compensation for IRA purposes, so Leroy cannot contribute to a Roth or a traditional IRA. Even if he has the money to do it, he can't do it because he doesn't have any earned income for the year. Example number 3. Connie is 17 years old and has a part-time job. She is claimed as a dependent on her parents' return. She earns $4,350 in wages. She also has $2,050 in dividend income. Connie may contribute to an IRA because she has qualifying earned income, which is her wages. And she's actually allowed to contribute to a Roth or a traditional IRA if she wants, even though she's claimed as a dependent on her parents' return. And many times, parents will encourage their children to do this if they already have earned income. You know, she's 17. She's still a minor. But that doesn't preclude her from contributing to either a traditional IRA or a Roth. She can do either one. And she's actually allowed to deduct her traditional IRA contribution if she actually does contribute her wages to a traditional IRA. There's nothing stopping her from doing it. And her parents can still claim her as a dependent on their tax return, even if she does this. So there's no age limits with regards to minors. Like if you have a baby who's like a child actor, then they have self-employment income because they're in commercials or something, or in a diaper ad or whatever. You could set up a traditional IRA or a Roth IRA for an infant if they actually do have qualifying compensation. And many parents will do this because they want their children to have a retirement account that will continue to grow throughout their lifetime. So there's nothing stopping her from contributing to either a traditional or a Roth as long as she has qualifying compensation, but her contribution would be limited to $4,350, which is the amount of her wages. The investment income would not be qualifying compensation for IRA purposes. Connie would be allowed to take a deduction for her IRA contribution on her individual tax return, even if she is claimed as a dependent by her parents. The next webinar covers spousal IRA contributions. Let's talk about spousal IRA contributions. Spousal IRA contributions. IRAs cannot be owned jointly. You cannot have a joint IRA. There's no such thing. It doesn't exist. Each spouse has to have their own IRA account in the case of a married couple. However, a married couple filing jointly may contribute to each of their IRA accounts, even if only one taxpayer has qualifying compensation. So only one spouse actually has to be working. And that's also true if they're self-employed. You don't have to have both spouses working if they are married and file a joint return. If they're married and file jointly, then both of the spouses can have an IRA, and both of those spouses can contribute to that IRA. And it's called a spousal IRA contribution. Unmarried couples can't do this. This only applies to married couples. And it also doesn't apply if you have a parent and a child. I've been asked this before. You know how sometimes you could potentially have a child that is claimed as a dependent on their parent's tax return, but the child also has income coming in. A child can have an IRA, and they can contribute to that IRA if they have qualifying compensation. For example, if they have a job, they can do that. But the contribution would always be based on their own compensation, not their parents' compensation. If, in fact, it is a child that is working, and the child or the parents, they want to set up an IRA account so they can start saving even while they're young, that's perfectly fine as long as the child has earned income, like wages or self-employment income if the child happens to have a business. But in the case of spouses, a married couple, that's the only time where one person doesn't necessarily have to have qualifying compensation in order to contribute to an IRA, if they are married and they file jointly. However, if you have a married couple and they choose to file separately, they must consider only their own qualifying compensation for IRA contribution purposes. For the exam, you need to realize that this has been a trick question in the past. If you see any kind of question where it says married filing separate or they're filing separate, and it's an IRA question specifically about their contribution limits or anything like that, just realize that that's a trick question. It's going to be a trick question if they're telling you that the couple files separate tax returns. Just look for that on the test. And let me give you some examples. Example number 1. Frank is 35. He works full-time and earned $55,000 in wages during the year. His wife, Danielle, is 34 and earned $3,600. They choose to file MFS. If you see MFS or filing separately or they chose to file separate, then you know that this is a trick question. This is a tricky scenario. Therefore, Danielle is limited to $3,600 for an IRA contribution. That's the amount of her qualifying compensation. And sometimes they'll give you a scenario too where the other spouse has a little bit of wages like her, like Danielle, but then they have a bunch of compensation that's not qualifying compensation, like rental income. Like let's say she had $3,600 in wages, but then she had another $30,000 in passive rental income. The passive rental income is not qualifying compensation. So if they file separate tax returns, then the most that she can put into her IRA would be the $3,600 in her wages, for example. Frank, on the other hand, may contribute the full $6,500, which is the limit for his age, to his own IRA accounts. Now, example number 2. John, 49, and Elaine, 51, are married and file jointly. John works as a paramedic and makes $76,000 per year. Elaine is a homemaker and has no taxable income. So Elaine is not working. She does not have a job. Even though Elaine has no qualifying compensation, they may contribute to her IRA accounts. And this would be a spousal contribution. Their combined maximum contribution is $14,000. Another tricky scenario. John may contribute $6,500 to his IRA because he's 49. Right? He's under the age of 50. So the most that he can put in is $6,500. Elaine may contribute $7,500 to her IRA because she is over 50 years old. The wife in this case is a little bit older than the husband. And this is a tricky scenario because she's over the age of 50. So she actually gets to put in more. And sometimes on the exam, they will ask you what's the maximum combined contribution that they can make. Don't be confused by this. She gets more because she's over 50 years of age. So she can put in $7,500 and he can put in $6,500. This special rule only applies if the married taxpayers file jointly. So they have to file jointly in order to do this, but they can both fund a retirement account even though he's the only one that's working. But look at the ages and also carefully watch for that married filing separate verbiage. The next webinar covers self-employment income and wages for IRA contribution purposes. So for example, if I have a Schedule C business and that's all Let's talk about the special rule for self-employment income plus wages. If a person's only qualifying compensation for the year is from self-employment and the self-employment activity generates a loss for the year, the taxpayer cannot contribute to an IRA. So for example, if I have a Schedule C business and that's all the income that I have coming in for the year, and my business shows a loss on the Schedule C, then I can't contribute to an IRA. Because I have a loss on my Schedule C, so I don't have any earned income. You have to have earned income in order to contribute to a retirement account. However, if the taxpayer has wages in addition to self-employment income, so they have a job, plus they have a business, if they have a loss from self-employment, it would not be subtracted from the wages when figuring the total qualifying compensation income for the purposes of determining an IRA contribution. If you have a person who has wages, they have a job, but then they also have a Schedule C business, and the Schedule C business shows a loss, The loss from their Schedule C will offset their wages on the income tax return in order to offset income tax. It will. But for determining their qualifying compensation in order to make an IRA contribution specifically, they can use the full amount of their wages, and they don't have to reduce the full amount of their wages by the loss that they show on the Schedule C in order to make an IRA contribution. And I'm going to give you an example of this so you understand how this works. For married taxpayers filing a joint return, the combined IRA contributions cannot exceed their combined qualifying compensation. And I'm going to give you an example of that as well. Example, Nancy, age 55, so she's over the age of 50, has a profitable rental property netting $30,000 in passive income, which she reports on Schedule E. Now, you already know that rental income is not going to qualify as earned income, but she has this money coming in. So she has $30,000 in passive rental income. She also works part-time at a coffee shop, earning $7,000 in wages. She's also self-employed as a rideshare driver on the weekends, but has a net loss of $2,500 on her Schedule C business for the year. So you understand the scenario, right? She's got $30,000 in passive income from a rental. That's not qualifying compensation. She also has $7,000 in wages as an employee because she's working part-time in a coffee shop. Then she also works as a rideshare driver on weekends, like for Uber, but she has a net loss from her Schedule C business for the year. Her earned income for the year is only $4,500, and that's how it would look on the tax return. Her loss from her Schedule C would offset her wages. It would be $7,000 in wages minus the $2,500 loss from self-employment. So this is her earned income for the year for income tax purposes, But her qualifying compensation for the purposes of an IRA contribution remains at $7,000, the amount of her wages. Thus, Nancy can contribute $7,000 to her IRA, assuming she has enough available funds to do so. And usually, this only becomes an issue when taxpayers are a little bit older. For the most part, that's the only time where I've really seen this sort of thing. Many times people who are older, they're in their 60s or even sometimes in their 70s, they still want to contribute to their IRAs or to their retirement accounts. And many times those people won't have earned income because they're retired. They're mostly retired and they're receiving Social Security and maybe interest and dividends, but that's not qualifying compensation. But they still want to fund a retirement account because the whole idea is that, people are living longer and they want to still put money into a retirement account, fund their retirement, and maybe even with the idea that they're going to pass those retirement accounts on to their heirs or to their children once they pass away. So they will still want to fund a retirement account, but many times when they're older people, they only have a little bit of earned income. Maybe they have a little part-time job, or maybe they're doing a little bit of self-employment income. I just had one last year where it was a gentleman who was almost completely retired. He was in his 70s, but he still had like a little farm where he sold like 1 or 2 cows every year. And he had asked, can I still fund an IRA by selling these little, like a little Schedule F activity? I sell a few cows a year, and, he had a profit motive in the activity, but he also wanted to know, do I have to file a tax return? And I said, yes, you have to file a tax return because this is self-employment income. And it was only a couple $1,000s. The rest of his income was just passive, from pension. He had a pension, some Social Security, and he just had this little Schedule C business from selling a few cows a year. It was Schedule F because he was a farmer. But it was still qualifying compensation, and he could use that little amount. It was like $2,000, $2,500 in profits in order to put into a retirement account. But that's the most that he could put into a retirement account because that's all the earned income that he had. But if it is a situation where a person has wages and they also have a loss from self-employment, then those two things will net on the tax return. Do a sample tax return in order to see this if you want. The income will net each other for income tax purposes. The amount of the loss on the Schedule C or the Schedule F, if it's a farmer, will reduce the amount of their income on the tax return for income tax purposes. But if they want to put money into a retirement account, If they want to fund an IRA, whether it's a traditional or a Roth, you got to have earned income either way. They can still fund their IRA and they can use the total amount of their wages in order to figure out their maximum contribution. In this case, in this example, $7,000 in wages is the amount that she could put in maximum into her IRA accounts. Example number 2. Robert and Betty are a 62-year-old married couple who typically file their taxes jointly. This year, Robert has made $53,000 in passive income from his commercial rental property, while Betty earned $28,000 in qualified dividends and additional $8,000 from a part-time job. These are their only sources of income for the year. Only Betty's wages count as qualifying compensation for the purposes of an IRA contribution. You see, Robert has $53,000 in income, but it's all from a commercial rental. So you're going to assume that that's passive and it's reported on the Schedule E. So that's not qualifying compensation for an IRA. It's not subject to self-employment tax and it's not subject to FICA. So if the income is not subject to payroll taxes, most of the time it's not going to be qualifying compensation for the purposes of a retirement plan contribution. Betty had qualified dividends, which are portfolio income. That's investment income, so that's not qualifying compensation either. And then she had $8,000 from a part-time job. So together, if they file jointly, they can contribute up to $8,000 to their IRA if they file jointly, because Betty's the only one that had any earned income. So if both of them want to contribute, they can, but they have to file jointly if they want to do that, because Betty is the only one that had any earned income. If they file separate returns, then only Betty can contribute to her IRA, and Robert can't contribute to his IRA at all because he doesn't have any earned income. But if they file jointly, they can contribute up to $8,000 to their IRAs. They can divide the $8,000 equally between their respective IRAs, which would equal $4,000 each, or split it in any other way that they choose. So they could choose the split, and that's fine. But the most that they would be able to put in together is $8,000 because that's the only earned income that Betty had for the whole year. And Robert doesn't have any qualifying compensation. Regardless of how they split their contributions, their total combined contributions cannot exceed $8,000 for the year, which is the wages that she had. That's it. Next webinar covers Roth IRAs and IRA distributions.
Let's talk about Roth IRAs and IRA distributions. Let's talk about Roth IRAs. Let's talk about Roth IRAs and IRA distributions.
Ay, di na record.